What is stop loss in trading? Imagine you have just bought some shares of a company, hoping their price will go up. But, as any seasoned trader knows, the market can be unpredictable. To protect yourself from significant losses if the price unexpectedly drops, you can set up a safety net. That's essentially what a stop loss order is. Think of it as telling your broker, hey, if this stock's price falls to this specific point, just sell it for me automatically. This order sits quietly in the background until that price level, called the stop price, is touched or even goes a bit beyond it. Once that happens, it's like a trigger has been pulled. Your stop loss order then usually transforms into a market order. This means your broker will try to sell your shares as quickly as possible at the best price they can get at that exact moment. Why is this so important? Well, primarily, it's about limiting your losses. It's like having an escape hatch if your trade starts going south. Instead of watching your potential losses grow and grow, the stop loss kicks in and gets you out before things get too painful financially. But it's not just about cutting losses. You can also use a stop loss to protect profits you have already made. Let's say your stock has gone up nicely. You could set a stop loss order a little below the current price. That way, if the price suddenly reverses, you are guaranteed to sell at a price that still locks in some of your gains. Beyond the financial benefits, stop losses also bring emotional discipline to your trading. It takes away the temptation to hold on to a losing trade, hoping it will magically bounce back. The stop loss acts as an unemotional, preset rule that you have already decided to follow. Plus, it offers automation. You don't have to glue your eyes to the screen all day, worrying about price swings. The stop loss is there, working in the background. Now, there are different flavors of stop loss orders. The most common is the market stop loss order, which we have already talked about. It triggers a market sell order once the stop price is reached. Just be aware that in fast-moving markets, the price you actually sell at might be a little different from your stop price. That's called slippage. Then there's the stop limit order. This gives you a bit more control. When the stop price is hit, it doesn't just become a market order, it becomes a limit order to sell at a specific price you set, or better. The upside is price control, but the downside is that if the market keeps falling quickly past your limit price, your order might not get filled at all. A fixed stop loss order is straightforward. You set it at a particular price, and it stays there unless you manually change it. Finally, there's the clever trailing stop loss order. Imagine you are riding a wave of profit. This type of stop loss moves with the price as it goes up. For example, you could set it to always be 5% below the highest price the stock has reached. If the price keeps climbing, your stop loss level also rises, locking in more and more profit. But if the price drops by that 5%, your stop loss is triggered. So, in a nutshell, a stop loss is like a safety mechanism for your trades. It's an automated instruction to get you out of a position if it starts moving against you, helping you manage risk and protect your capital. It's a fundamental tool in any trader's arsenal.